Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Pavitra Parekh and Sonia Shenoy. Good morning, girls. I think resilience is my name, right? Wall Street has closed in the red every single session this week. It's down 2.5%. And look at the Indian market holding well above that 18,000 mark despite the tumultuous external environment.
Absolutely, right? 18,000 is holding, it's firm. It's the end of the week, by the way. So let's get our first guest on board. It's also largely the end of the earnings season. Of course, we do have big earnings, the likes of SBI coming out tomorrow. But Gautam Duggad, our first guest of the day, is joining in. He's the head of Research Institutional Equities at Motilal Oswal. So let's get him on board. Gautam, good morning and thanks for being with us. You've written a very interesting report on the Q2 earnings and you've covered about 100 companies. Tell us a little bit about what the fine print has been. By and large, it's been a good earnings season. Banks have done well. Technology, not too bad. What are you picking up as the big themes that investors can look at?
Hi, Sonia. Good morning. Thanks for having me. So, broad theme is very simple. The numbers have been largely in line with expectations. Nifty earnings are flat on a reported basis for the 34 companies which have reported. But X of commodities, which is basically metals and oil and gas, the earnings are up 25% versus expectation of about 20%. And even for the broad coverage that we track, while on a reported basis, earnings are down about 6-7%, they're still slightly better versus our expectation of about 10-11% decline. And even for the broader segment, excluding commodities, the earnings are up about 25%. So what is doing well, as you rightly pointed out, banks and auto, which is pulling the numbers up. Consumer and IT are in line with expectations at about 15% growth for consumer and 7-8% growth for IT. So far, pharma has surprised a little bit given the beat in Sun Pharma's earnings. And metals, cement, commodities, they're all down by a big margin, which is in line with expectations again. But more importantly, the earnings revision is fairly stable. There is marginal upward revision, about 0.4, 0.5% kind of a number for both FY23 and FY24 Nifty EPS. So we are at about 820 rupees for FY23 now, and roughly 985, 990 rupees for FY24, which basically translates into a 12% earnings growth for FY23.
Gautam, morning. So on the subject of valuations, now, as your report points out, the Nifty is trading at 22 times FY23 PE, which is higher than a long period average. But there is no saying that it can't get more expensive from here on and valuations can't rise. Can you tell us, in the past cycles that you've analyzed, how high have India's valuations gone? When a lot of things are working in its favor, this 22 times can very well become 25 times. Anything that we can learn from the past cycles on valuations?
Yeah, Reema, you're right. Valuations do have some room for upside if you go by past cycles, but we must also remember that no two cycles are similar. Basically, the way to look at numbers right now on valuations is on a 12-month forward basis, Nifty is trading at 19.6 times, on a price to earnings basis, which is bang in line with its long period averages, right? The noise, however, on valuations is emanating because on a relative basis, we have done very well, whereas the global markets have struggled in the trailing 12 months. So when you look at India's valuations in the context of MSCI emerging markets, the premium now is a staggering 155%, which is at an all-time high. Because the rest of the markets have done pretty much nothing. Secondly, if you look at the trailing returns on a last 10-year basis, MSCI India has given you 11.5% kind of a CAGR for a decade, whereas MSCI Emerging Market has given a negative 1.5%. And the numbers are similar even on a trailing 5-year basis. So while one can always make that argument that relatively India's valuations are expensive vis-a-vis other emerging markets, but that has always been the case. On its own, on an absolute basis, Nifty is bang in line with its long period averages. The forward returns from here, as we have also mentioned in our note, will be a function of where the earnings settle. Because last 2 years, earnings have been excellent. After a 10-year of 5.5-6% kind of a CAGR from 2010 to 2021, we saw 20% growth. 2022, we saw 40% growth. And this year, we are at about 12% growth. So in 3 years, the earnings are up 80% cumulatively. Nifty's profits have gone up from 3.5 trillion to 6.6 trillion. If the expectations which are there for FY24 are met, then I think we still have some room for upside on a 12-month forward basis.
You're saying that India's valuation premium over the other emerging markets is at a record 155%. We've never
Yeah.
seen this kind of a valuation premium in the past.
Not at least in the last 15 years. But see, it is like this. While we are at about 20, 21 times on a 12-month forward basis, the rest of the markets are trading at 10 times. So, it's more a reflection of the relative outperformance. If you look at the trailing 12 months, India is flat or maybe up 2-3%. But rest of the markets are down 20-25%. So it's not as if India's absolute valuations have gone through the roof and are trading at 25, 26 times, and therefore one needs to be extremely cautious. The premium is more a reflection of what the other markets have done rather than what India per se has done on an absolute basis. That being said, one always have to be cautious given the environment that we are living in, especially on the global macro front, and with 300 bips of cumulative rate hikes in the past 4 Fed cycles. So it always pays to be cautious and keep an eye on earnings.
All right. Hi, Gautam. Good morning, and thanks for joining us. This is Pavitra. Like you were pointing out, all of the banks have, of course, done very well this quarter. Do you expect that even going forward, a bunch of the heavy lifting for the index will be, will come in from the banks? And also within the banking space, if you could break it up in terms of, what you're really seeing for the larger banks, for the mid caps, how do you expect that to trend?
So, Pavitra, financials have been a very consistent, performer in terms of earnings. If you look at just the Nifty 11 financial companies, the earnings cumulatively bottomed out in FY18 at a profit of about 45,000 crores. And now we are reaching roughly 2 lakh crores in FY23. So it's a 35% CAGR on a 5-year basis. What has changed in the last 2-3 quarters is the PSU banks, the non-SBI PSU banks, basically, that basket is also doing well on earnings. So we saw earnings of Canara, Union Bank, Bank of India, all of them have been very strong set of numbers. Our expectations for next 2 years is also very benign on financial earnings. So we are expecting a 20% growth on a higher base in FY23 for Nifty financials earnings. So we are expecting the profits to move from 2 trillion to 2.4 trillion. What is fueling this is clearly the pickup in credit growth. You can always credit part of that to the rising inflation. Second, we are also seeing margins being fairly solid in the early part of the rising interest rate regime. And third, obviously, what has consistently helped the profitability of financials in the last 4 years is a cleanup in asset quality, where the provisions are consistently going down. And now we are seeing a big benefit which is coming through in the non-private banks basket as well. So this year, 63% of incremental earnings growth in Nifty will be led by financials. In fact, for the quarter also, if you look at numbers excluding financials, there is a decline, which is coming because of commodities. So financials remain a very important cog in the wheel as far as earnings are concerned, and even valuations there are fairly okay. So there is room for upside clearly in financials.
Room for upside in financials. You can see it in the stocks as well. In your top FY23 upgrades, Gautam, you have Maruti as one of the stocks. I just had a question there. Agreed that Maruti has the tailwind of raw material costs and, they have some new launches. But you're going with the assumption that the new SUV launches will do well, A. There are also concerns about commodity inflation in Q4, which the management has alluded to. And then there is higher marketing costs, right, which could put a lid on perhaps a more margin uptick. Would that be of a concern to you?
See, Sonia, for 5 years, auto cycle has been in the downtrend. Like I mentioned, banks' profits bottomed out in FY18. Exactly the reverse happened with automobiles. The automobiles profit in Nifty peaked out in FY18. And from 30,000 crores of cumulative profits for auto sector in Nifty in FY18, they were down to just about 8,000 crores in FY22, right? After a long time, we are seeing some things falling in place for auto, which is demand being strong, supply issues at the margin easing out, and commodity prices correcting. And we have seen that the festive season has been fairly okay for four-wheelers. That being said, on a last 5-year trailing basis, earnings are still down, right? And stock is also down, rightly so, because if I remember well, Maruti peaked out at 10,000 rupees somewhere around January 2018. So this is the first quarter of a good earnings that we have seen in Maruti. if the underlying trends are anything to go by on demand and supply, we expect the momentum to continue for a few more quarters. Of course, with a cyclical sector like auto, one has to always keep an eye on multiple things, which is interest rates, because there have been rate hikes which have happened in India as well, and there are expectations of few more rate hikes going forward. So how that plays out for demand will be a very important determinant of how Maruti and some of the other discretionary stocks in the four-wheeler segments perform.
Gautam, we'll have to leave it at that. You're a busy man. Thank you very much for joining us and speaking to us. Get into a break. Up next, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins in next.